Welcome to TMS Insights. It's now in December 2016. Ben Clark and Jeremy Hook bringing you the update of what's been going on in a very tumultuous time in the market since we last updated you when the US federal and presidential election had been held. A lot was going on, a lot's changed, Ben, and the markets have really almost turned upside down in terms of which stocks have become the winners and which have been the losers from where it was earlier in the year.
Yeah, I mean, I guess the first thing I'd start by saying is that Trump didn't end up being a terrible event for the market, which we suspect, well, we hoped it wasn't going to be, but it certainly wasn't a time to worry or to panic about that outcome. But it has seen a big dynamic shift in two areas of our market, I think. The first is the move in the bond markets, which was happening prior to the Trump win, has accelerated since the Trump win. So we've seen a big increase in bond yields right around the world, virtually every country in the world. And that in turn has led to a quite meaningful sell-off in infrastructure stocks, in property trusts, and in other so-called bond proxies. But on the positive side, those companies that have been in despair about the low cash rates and what that's meant about their businesses have seen big rallies, QBE, Computershare, Flight Centre, as a result. So that's been one thing. But I think the other thing that's probably less understood, and it's happening very rapidly, is over the last few years, the large fund managers in our country, perpetuals, colonial first states, etc., who traditionally invest in blue chip shares, were looking at their investment universe and seeing very little growth across a lot of their companies. And over time, they've pushed into the mid-cap, high-quality sort of earnings growth area of our market, which has been a wonderful place to be for 3 or 4 years. But in the last 3 or 4 months, there's been a very quick unwind of those positions. And so the earnings growth mid-caps are being sold down aggressively to buy back into resources and banks, which and
the big story there, I mean, bonds lead equities almost every time, and the bond market sell-off follows a 13-year bull run for bonds. So the sell-off in bond proxies also follows an incredibly very positive run for investments in that space. So that needs to be understood, the two sides of that.
Definitely.
So that was definitely a November into early December consequence. We've seen all those kinds of stocks you've mentioned sold off. But we might just focus on the winners for a bit to get a sense of it. So the prevailing thought that drove a lot of investment in the markets was that banks were going nowhere. They were low growth, under regulatory fear and all of that kind of thing. They've actually performed extremely well in the last little while as the bond yield has normalised. There's a positive gradient on that yield curve now, and that's really good for the outlook for margins of the banks. So their share prices have done well.
You would have, those with mortgages would have seen that CBA and in fact now all 4 of the big banks have significantly lifted their 3 and 5 year mortgage rates, so they're going to start to get some margin back. CBA I think lifted by 0.6% last week their 5-year rate per annum, so it's quite a big move. If you go back 12 months, every fund manager in this country was saying that the banks are going to have to do another round of capital raisings, whether they like it or not. They're going to have to do it. So there was this view amongst the professional investors that we don't have to be market weight the banks or overweight. We can be underweight because we'll be able to buy more shares in the capital raisings next year, and we'll put that money to use elsewhere. And that thought has changed over the year, and I think now the consensus will be that they're not going to have to do more capital raisings. As the views change, the share prices start to run, and the fund managers have started to buy back into the banks. So even though they've got fairly low growth outlooks, they looked cheap for quite a period of time, didn't they?
Absolutely, and great yields. And we've seen the banks recently report in early November, and those dividends from Westpac, NAB and ANZ all about to be banked just before Christmas as well, so people will enjoy seeing those. The other sector that's done particularly well, partly related, but it was happening a bit before the US election, has been the material space, so resources. And more recently, as of last week, since the OPEC agreement was reached, energy stocks have done well as well.
Yeah, definitely. I mean, we have seen some phenomenal. I think without borrowing your line that you said, I heard you say the other day, was that whatever haven't wanted to own for the last 4 years, you've wanted to own in the last 4 months, and whatever you haven't wanted to own for the last 4 years, you have over the last 4 months. So it's been that type of market, and resource stocks after 4 terrible years have had a great year this year. The South 32 has tripled, Fortescue has tripled, BHP is up about 80%, and Rio's done something similar. And then we had the oil guys are starting to enjoy the rally as well.
Just now, yeah.
Santos, Origin, Woodside, with a better oil price, and it looks like a cut in global production, which is trying to get prices back up. That's music to their ears.
Okay, and some sectors which have been hit, to talk about sectors, and we'll get into stocks, but healthcare has been a well-performed sector for a long time.
Yep.
Certainly come under a bit of pressure, valuation-based largely across the board. It seems that people are just deciding it's a good run, and to fund the purchases in the areas we've just mentioned, healthcare's suffered some selling.
Yeah, and look, it's been quite a vicious correction. You'd have to from its highs, which and there was a spike into some of those highs, but a lot of those stocks are off 20% from their highs. I mean, CSL, which is the largest one, hit $118. It's now at 96, so it's been a good 20% fall from its high. And we were looking at some data from the GFC. The healthcare stocks back in the GFC fell about 23-24%. They've fallen about 18 to 20% in the last few months. So we've almost seen a GFC style event, but it's flowed into other areas, Jeremy. And the thing that I look at is that it's a bit indiscriminate in that whether it's Domino's Pizza, Aristocrat Leisure, the healthcare stocks, the telcos. I mean, that you could put reasons down to all of them being weak, but across the board, across the board, these stocks have come off quite aggressively.
Yeah, and maybe that's a time to jump into a couple of individual stocks that we've talked about and people know. Icentia is one. We know that came out with a profit warning at its AGM, effectively saying that the King Content acquisition wasn't delivering and for the market to expect a little bit less. Obviously a company that we've watched and do like, certainly probably like on the adjusted price.
Yeah.
And the business overall, apart from that newer acquisition, is basically in quite good shape, Ben.
Yeah, I think so. And I think although it's a black mark to management when you buy a business and so quickly have to reduce the expectations that you gave the market in terms of its performance, it was a very small purchase versus the overall size of the company. And Vocus has been another one where we've had a similar scenario, I suppose. Yeah. I mean, leading into the Vocus result, the market's concerns were based around the NBN and how the rollout was going to affect their profit margins, their customer numbers, for every player in the telco space. And actually, the AGM update, the negative was in the next gen business, which they've only just acquired, and they've had to reduce down the expectations of the market versus what we're told to expect from that acquisition. So they're going to have to work hard to turn that around.
And this was actually coming into the AGM when they'd been sold down significantly. We knew there were board troubles. We knew there was some management departures, but the AGM possibly could have given it a little bit of hope.
Yep.
Instead, it didn't. It gave it right down on the next gen business. So the market was vindictive.
Yeah,
and there's no doubt about it. And that's the theme you saw, Icentia, Vocus. The acquisitions haven't delivered, and it's a theme that makes the market edgy about acquisitions generally.
Yeah, definitely. And I think when you see money coming out of this sector, if there's been a whiff of negative news, it's come out a lot more aggressively from the fund managers.
Yeah.
Because you look at even something like REA, which reported on the day of the Trump win, and in a market that I think got sold off 150 points, it was up $2 or something. The market clearly liked that result.
Yeah.
We have still seen a $15 fall in that share price from recent highs. So sometimes it's related to fundamentals, sometimes it's not. It's a frustrating period, I'd have to say, at the moment, but it also throws up opportunities.
And one that we might leave on is a surprise bid announced to the market yesterday for Duet by CKI, which is a Hong Kong-based infrastructure investor. Again, against that theme that the bond proxies should be avoided at all costs, they've launched what is a very substantial bid for Duet that will play out over the next few weeks.
Yep, $3 cash per share. I think we were all surprised when we saw the headline. CKI have got form in this country. They've got some big interests. They took over Investor a couple of years ago. And the issue that they're going to have, and why the market hasn't reacted to send that share price really close to $3, is that, of course, the federal government stepped in when New South Wales was selling off the poles and wires and didn't want CKI to participate in that process. So Scott Morrison will have to have a look at this transaction and make sure he's happy with it. How he reacts to it, we're not too sure. And there has been some talk of some other groups now running the numbers on Duet, but my personal view is if it got close to $3, I'd probably be saying it's a sell, given the uncertainty around the bona fides of the bidder, but it's not there at the moment. And so probably a hold for now is the advice we'd be giving to clients.
In the 270s, a hold, and we'd be interested if it did get close to $3 to take a bit of money and run, I think, which would be good to in what's been a tricky period in the market, but one that we've kept our eye on and hopefully updated you on today. We look forward to bringing you more news next time.